How you guys doing? No, come on. How you guys doing? Good. Yeah. All right. I'll let Ben intro himself in a second. If you don't know Ben is probably like the godfather of this era of direct-to-consumer. He's an old man, but he co-founded Hubble Contacts, which, when was that? A decade?
2016.
Yeah, 2016, almost a decade, and has kind of always been like the shining star in the industry in terms of how to grow a brand, how to retain customers, how to go circumvent the normal things. And so I'm very excited to be here with Ben, and I've gotten to know Ben over the last few years, and I can certify he's very smart. So,
thanks, Nick.
To start us off, Ben, do you want to tell us how you got into this world of direct-to-consumer and how you got into Hubble and then eventually to Agora?
Sure. Great to meet everyone. As I'll talk about a little bit later in this conversation, I think the fact that we raised as much money as we've had is sort of a negative thing. And so we'll see, I think, some of the downsides that we've learned or I've learned about raising venture capital in the DTC market. But anyway, thanks, Nick, and excited to be here, and Abhi and everyone else. So I got into D2C and e-commerce, worked in consulting and worked at Harry's, the men's shaving company, which a lot of you guys probably know, actually based around here in Soho. Great business. I was always a contact lens wearer, though. Harry's was founded by one of the Warby Parker co-founders. You could sort of start to see the gears turning in my head. Always felt the price of contact lenses was too expensive. Always thought that, it was crazy inconvenient to buy contact lenses, as anyone who wears them here can probably attest to. So figured something similar to the Warby Parker or Casper or Dollar Shave Club or Harry's model could potentially work for the contact lens space. So started a business called Hubble Contacts, direct-to-consumer contact lens company in 2016, and raised quite a lot of venture funding for it, and we were off to the races from there.
So since starting Hubble, you've raised a ton of money. All the VCs love you, by the way. How have you seen the shift from when everybody was raising money, pre-launch of a brand, valuation of $15 million, raising $3 million, and then the second that you have, hit that valuation in terms of maybe run rate or whatever, it's going to raise the next round. How have you seen that change over the last 8 years since you started?
Yeah, I put together some slides here that show the stock prices of some of the most prominent direct-to-consumer brands, and I'll go through it in a second. But to answer your question quickly, there's been a total shift, as people probably here know, from valuing your company on a revenue multiple or based on impressions. It was really revenue, to be fair, to in the last few years valuing businesses based on profitability, cash flow, how much money you actually make, not how much you're able to spend on Facebook ads to grow your top line, though we did that very successfully at the beginning. And I think that shift is really healthy in the industry. Since Hubble, after 5 years, I left and started another business called Agora, which is acquiring bootstrapped, profitable, direct-to-consumer brands, and that has been really rewarding. I think we've seen a lot of the issues with the venture-backed D2C model, the grow at all costs, grow revenue model, and Hubble now, I'm proud to say, is a profitable business, but it took a long time and a lot of venture capital dollars to get there. Agora, what I'm doing now is acquiring bootstrapped, didn't raise any funding, just profitable from day one, businesses. And those businesses, honestly, I think are much, much harder to run. And so everyone who here runs that type of business or works in that type of business, tip of the cap, because you are very constrained by profitability as an actual metric that you need to care about. And I think it's a healthy evolution versus where we were in the zero interest rate phenomenon environment of 2016. But a lot of the businesses that did raise a lot of funding went public in 2020 and 2021. So I just want to walk through how those brands are doing. Nothing against a lot of these brands. Again, Warby, I have so much respect for. Specifically, I know one of the co-founders hired me at Harry's the first time, and I know a lot of the other brands that are on this list. They did a great job, and I think if Hubble were a public company, the stock price would look pretty similar. So it's not anything personal, but I just want to be upfront about the venture-backed D2C model in the public markets. Private markets are similar. Obviously, we don't have the data for them. Public markets you have data for, but it's not just public companies. It's really all direct-to-consumer businesses. So we can walk through. Warby Parker, down 77% from peak. Honest Company is down 87% from peak. Hims, 65%. Hims is actually almost back to where it was when it de-SPAC'd or IPO'd. So they've done incredibly well, but still down 65% from peak. Rent the Runway is kind of a D2C commerce business, kind of not, down 98%. Allbirds, famously now, down 96% from peak. HelloFresh is actually slightly profitable, barely profitable, and one of the best performing D2C brands, and still down 87% from peak. Solo Brands is an e-commerce aggregator, outdoor space, down 88%. Figs, really respect the company. They make clothing for medical professionals and things like that, down 88%. Oatly, partially D2C, sells in stores too, down 96%. Bark, down 95%. Grove Collaborative, 96%. Purple, which is a mattress business, down 97%. Brilliant Earth, 83%. Blue Apron, actually down 100%, and I think it got acquired. AK Brands, another aggregator, down 95%. There were some other brands that we initially had here, like Smile Direct Club, which just fully went out of business, down 100%. So it is not pretty. I don't know if this is the exact right way to start off a conference about D2C, but I figured it was worth it.
What are we doing here?
It was worth it to show you guys what we're up against.
Yeah, why do you think Wall Street hates D2C? Is it because it's so reliant on Facebook and performance marketing, and they're used to Netflix subscriptions and like Kate Spade or whatever? Like why do they hate D2C?
So good question. I don't think that Wall Street hates D2C necessarily. There are some brands that are consumer packaged goods brands, a lot of it D2C, like On, the running company, which is killing it. Wall Street does not like brands that are unprofitable and not growing. And basically every brand that I showed above, with very few exceptions, does not make money. We live in a very different environment from when Hubble started in 2016, when you could grow revenue at all costs and, as you said, raise 3 on 15 million and just continue to grow based on the money raised, investing into Facebook ads. You can now make 5.5% risk-free returns in treasuries, not to get too finance focused about it, but if you're an investor and you can get 5.5% guaranteed returns from the government, or you can buy a brand that's not really growing and not really making money, I know what I would choose. And so a lot of this is, I think, how the interest rate environment has changed. But a lot of these brands went public in 2020, 2021. They were supposed to grow into profitability. They've continued to kind of grow, but they're still not profitable, and the market's realized it.
So today, when you run the brands with Agora, how are you running them, or how are you growing them differently, and how are you thinking about financing them differently in a way where you're not giving away your equity?
Yeah, good question. So we buy brands that are profitable and only profitable from day one. And again, that's why I think it's so important to buy bootstrap brands. If you're a bootstrap brand, by definition, you have not raised external funding. So you have to have been profitable from day one. And those brands, I think, have true product market fit. If you can grow based on your profitability, you have a real desire for your products from customers, and you have, I think, durability for that reason. A lot of these brands up here that are public did not. So something we do at Agora, we care about growth, we care about revenue, but we mostly care about profit and cash flow. Actually, I'd say largely exclusively care about that. And revenue is for the sake of profit. If you want to grow profit eventually, you need to grow revenue, but profit is really what we're focused on. And so in some cases, we've actually decreased the revenue of a brand because they were spending too much on marketing or they were spending too much on some other area. But the brand is smaller, leaner, meaner, and more profitable.
And okay, so a couple of years ago, I bought a personal care brand and got completely fucked. Everything that everything that I'm good at on the marketing side, I was able to basically vet and validate very quickly because I could go in and see it. But everything I'm not good at, supply chain, raw materials, operations, logistics, shipping, ingredients, all these things, I got completely fucked on. What are the things you look for or look at to evaluate when you look at buying a brand?
Yeah, good question. So when we're looking at a brand, I would say first and foremost, what we are looking at is, and I keep harping on this, but it's true, we just look at the financials and we see if the brand is profitable. Not like community adjusted, EBITDA profitable, not like fake profitable, like in a generally accepted accounting principles way, does the business actually make money? And that includes things like inventory write-offs, that includes things like share-based compensation. All these things are real costs that you need to count when you're evaluating a business's profitability. So in my experience, if a business is consistently profitable for the past few years, that is a very good sign that it has real demand and product market fit with customers and will therefore continue to be profitable in the future. Not always, but usually. Of course, other things we look at are LTV to CAC ratio, how penetrated they are in various channels, whether we think we can launch them in other channels. All that stuff is really important. But I would say by far the most important thing is, has the business actually been profitable in a real accounting, not fake way?
That's a good point. Not fake is key. Okay, so one of the brands, I'm just jumping all over. One of the brands that I'm proudly an investor in is Jolie, the shower head company. And ever since, first when Jolie launched, nobody thought it was a good idea. Nobody wanted to invest. Told you so. Now, there's like every month there's a new shower head that's launching. And they all kind of are flopping in their own way outside of Jolie. And I've seen this happen in other categories as well, where there's a new product that comes to market or a new product that comes from the space. It does really well for one company, but completely flops for everybody else. And I've started to think that there's a difference between, pushing a product versus the positioning of the product. Have you seen the same thing with both Hubble and the other brands you're working with?
100%. And I have all the respect in the world for Ryan, right? He started Jolie, and I think he's done an amazing job. I think one of the things that Ryan did really well, which I am not particularly good at, to be honest, but I think is really important, is I think you are incredibly good at, is branding, and not just looking at like, what is your ROAS on Facebook? How is it more than 2.5 or 3x? Are you acquiring customers efficiently? That all is important, but if you want to build a large brand, you need to get to a place where the majority of your customers are getting acquired through organic channels or channels that you cannot track. I think a lot of the copycat, I don't know Jolie particularly well, but a lot of the copycats from what I see, like, you got a product, no one really knows what it is or trusts it, you throw it up on Facebook or Amazon, why would you buy it? Versus Jolie, which has, tens of thousands of influencers with social proof, great brand, and, clearly a really good product. I think you can take this too far. I know a lot of people, especially back in the venture capital days, who would like spend a ridiculous amount of money on brand marketing on Facebook, and it never really got customers down the road either, right? Like it's tricky. You have to spend money in a way that you can't predict necessarily how it will get you customers, and that's very dangerous because if you do that too much, you can just burn all your money. But it's a fine line. You need to spend enough money on channels that activate customers, get you customers organically over time, but not too much that you're just burning money and die.
And speaking of building brand, how do you think, like what do you think, tactically, what do you think are the best, most effective ways to build that brand? So you're not just running Facebook ads, but you're also not investing in things that clearly don't have a direct ROI. Are there any things you found tactically that have worked well for upper funnel, awareness, FOMO, that type of stuff?
Yeah, actually, I think you should answer this. I think you're better at this than I am. What do you think?
I think it's all about just figuring out how you stay top of mind, or the customers that you're going after. How do you intercept the places where they consume their content? So, one example is a client of ours is Armra. They're a colostrum supplement, and they're pretty much lower funnel exclusively. But one thing we did was we added a pop of upper funnel by having her go on the Skinny Confidential podcast. And that added this insane amount of awareness. Millions of people became aware of it right away. And then even taking those clips from the podcast and running those ads, those became the best performing ads. I think partnerships, collaborations, figuring out how you're participating in events in real life. I really do think it's about where are your customers either consuming information or getting new information, and how do you end up there?
The one other thing I'd add, I totally agree with all that, is I spend a lot of time thinking about marketing and branding. I really do believe that the market is pretty efficient at the end of the day, and the thing that matters most is your product. If you have a great product, people will eventually hear about it from friends, and it'll show up everywhere. You'll have lower cost of acquisition, you'll have better retention, you'll have more organic, you'll have better conversion on your site. Like, if you have a uniquely good product, I do think that ultimately is what drives everything, including your marketing. Probably the most successful direct-to-consumer business, which isn't really thought about as a direct-to-consumer business, is Tesla. Tesla is a $500 billion company. Elon Musk, I have a lot of issues with him, but he made a really unique product like 20 years before anyone else that it's taken, and now everyone's catching up. There's no marketing spent in Tesla. It's all him on Twitter, I guess, or launching rockets into space with cars in them. But he has, what a lot of people think is an amazing product, and that is not a CPG product, but it's probably the most successful direct-to-consumer business of all time.
And last question before we do a couple of questions from the audience, but what are your thoughts on celebrity brands? Like, you guys have this platform now where, in theory, you could bring a brand in and sort of run it through this machine. Have you guys thought about celebrities or influencers, faces of the brand, as a part of that machine?
Yeah, I, a couple years ago, thought this was a real key to success, and I think it can be, right? If you can get a celebrity to be part of your brand and, basically for that reason not have to pay the Facebook tax, because celebrities come and, they draw their own audience, they post on their own Instagram or whatever, I think that could be great. And there are some examples of this working really well. So like Mint Mobile. Mint is just a company that Ryan Reynolds, there's no really unique part of the business. It's just a marketing company. I think it's part of T-Mobile's network, whatever. And he, based on his own charisma, got it to more than $1 billion, $2 billion something valuation. Tip of the cap. That's amazing. There are other cases though. What's the name of the diaper business? The Bello brand. Hello Bello, yeah, which just I think went bankrupt with Kristen Bell, I think it was. And that business just didn't work at all. Core unit economics didn't work. So celebrities can definitely can help a lot. It's not a cure-all. And I think to make it work, you need to give the celebrities or the influencers a really large percentage of the business so that they are pretty incentivized to actually care about it. If you give them 1% to 2%, they're not going to really risk their brand by posting about it all the time. If they're a real full co-founder, like in the Mint case, I think it could work.
Yeah, I agree. I think the other thing I've learned too, I've seen 10 to 60% is the sweet spot of equity. And also, they have to be content creators. They can't just be Kristen Bell doesn't know how to use Instagram. And so they've got to be people who are good at creating content. All right, let's do a couple of questions from the audience. We got one right here.
So were you guys paid by Facebook to be here? Because you mentioned them
We're always paid by Facebook.
I paid Facebook a lot.
We pay Facebook, actually.
not be on Facebook?
I'm sorry,
Is
say
there
again?
any way you can build a brand without being on Facebook?
Sure. I mean, I think there is. It's not, the Facebook play is sort of a playbook, right? It's you can get a rough outline of how to do it and somewhat, you can somewhat rely on results to come through. There are ways to do it outside of Facebook. I mean, I think Elon Musk is a great example of that with Tesla. Any women in the audience know of Strawberry Milk Mob?
I was just about to write about them
Yeah.
on LinkedIn. That's
Yeah. I saw a couple hands go up. Strawberry Milk Mob is, if you guys don't know, it's one of the most amazing brands that blew up on TikTok, in my opinion. This girl who's probably my age just posts on TikTok, and she's built what I would imagine is probably a $10 to $20 million a year business selling bikinis, just storytelling through TikTok. At the end of the day, Facebook's just a channel, right? All it does is you put an image in Google Docs and Facebook helps you stretch the image. And so if you find other channels where you can put out something, you can put that image out and let the channel help you stretch that image, then at the end of the day, you're just trying to fight for eyeballs.
Hi. In terms of acquiring brands that are profitable and bootstrapped, do you see any limitations in terms of like the industries that people can break into with both of those factors at play?
Yeah, good question. So this is something we get asked about all the time from investors, like what particular categories do you think are most likely to succeed? We've pushed back here. I actually think any category can succeed. And I think it's largely because of sort of Econ 101. Like if there's a particular category that's less likely to be profitable or much harder to make work on Facebook or direct to consumer, that's true for the brand, but that's also true for all their competitor brands. And so it generally means that they can charge higher prices, they have higher margins, and you get, as a brand, rewarded for the difficulty of building a brand in that space. So I actually think the market's pretty efficient in that way, and there's not any particular category that's consistently better for a direct-to-consumer brand. If there are pretty low barriers to entry in D2C. It's not that expensive to start a new brand. And so if they're, like beauty, for example, is pretty hot right now, beauty and pets. But everyone knows that. And so there's a ton of new beauty and pet businesses getting started, and that's driving down profitability for each of the existing brands.
One more right here.
A question about talent. I don't know if this mic is on. Can you hear me now? Okay. So where do you source talent? Because as a self-bootstrap brand, I've been frustrated with sourcing talent that's kind of come from this pipeline in the last 8 years, and they arrive and they have all these expensive ideas that don't really have the constraints of we need this to work. And so how have you balanced finding?
I love that question. I 100% agree with you. We were very focused on like hiring people that worked at like Away or Casper or whatever. And like a lot of these people are really smart and work really hard, but they grew up in an environment, they worked in an environment that's not necessarily applicable to where we are today. And so I think that's fine as long as they're aware of where the current environment is and the constraints that we face today, but that's really important. So I don't know, I'd say for me, we're focused a lot at Agora and at Hubble on hiring offshore talent. And that's been really successful for us, both from a profitability perspective. Like you can hire amazingly hardworking people in the Philippines or India or South America for like 80 to 90% less than US or Canadian folks. And these people are incredibly smart and hardworking and just as, in many cases, honestly, better than American or Canadian talent that I've seen. And they work so hard, and I personally believe you should pay them above market wages. But above market wages in the Philippines is still like 80% less than US wages. But you can get such loyalty from people when you're overpaying them a bit based on their market wages. So we started doing this with customer service initially. A lot of people outsource customer service to the Philippines. We're now increasingly seeing you could outsource any job, basically any job that could be done remotely, I think could be done abroad. Supply chain, marketing, finance, like basically anything.
Yeah, I agree. We now have 7 people on our team from Sri Lanka. Also, are you the one hiring my cousins?
Yes.
We have 7 people from Sri Lanka. Anything from media buying, project management, executive assistants. Highly, highly recommend offshore. Happy to talk more about that after. All right, we've got, I think that's the end of our time. There are amazing sponsors here, by the way. Black Crow is here, Settle's here, Fermat's here, Amazon is here. Make sure you guys say what's up. Live Intent's here. These sponsors are not annoying. I'm invested in half of them. Pump my bag, build your business, it's a win-win-win. All right, I think that's our time.